So the maker methodology is the what's called the modified accelerated cost recovery system. Please don't memorize that. It doesn't matter. The maker's methodology is in lieu of your straight line depreciation. You do straight line depreciation is your standard. Makers is the itemized. So we're actually itemizing the assets and we're taking it. So it's just a different method for depreciation. The IRS has given us this method. It's dated back to the 1940s. This is not a new strategy. This strategy has been around for years and years and years, and our real estate pioneers have paved the way for us to be able to take an alternative method of depreciation. The reason the IRS allows us to accelerate the depreciation on certain assets is because those assets are not designed to last any longer than that. Carpeting, for instance, how many times are you going to replace carpet? Every 5 years, right? 5 to 7 years. You do not want to depreciate your carpet over 39 years. That's just asinine. So we want to make sure that we are depreciating it under those last class lives that make it more appropriate. And as a matter of fact, the IRS writes out it's called an audit technique guideline. Okay, they write a guideline for their auditors to review when they're doing an audit with a cost seg study. Okay, and in this audit technique guideline written by the IRS, it says that the preferred method for depreciation is the makers. And the reason for that is because it is much more substantive and it's much more aligned with what's actually going on in the property. If you're depreciating your carpet over 5 years, it should only be depreciated for 5 years because chances are you're going to replace it in that time period. Okay. So this is the preferred method of the IRS, and we're here to